Yes, Karna, we can start.
Good evening to all our KCF members. As India continues its unlock journey, we at KCF have always endeavored to bring relevant topics which will help our members in their business and investment decisions. In our last webinar on Saturday, we had a wonderful discussion on the bullion markets, which was very well received by our members. One asset class which has always generated enormous interest in the past from our members has been real estate. The common perception is that COVID-19 has truly hit this market hard. And given the large interest of our members in this segment, we thought it was timely to bring in an expert to decipher the ground reality in this asset class and also what the future holds. For us, the decision to call our speaker for today, Mr. Gulam Zia, was unanimous, especially after the success of our last program on real estate in September 2017, where his honest and frank views still echo with our members. While I think Mr. Zia requires no introduction, for the benefit of our new members, I will do the honors of introducing him. Mr. Zia has over 26 years of experience across an entire gamut of real estate services, transactions, project management, and advisory. Over the last 18 years in Knight Frank, Mr. Zia has advised some of the biggest developers, banks, private equity funds, corporate houses, governments, and administrative bodies on various real estate and infrastructure requirements. Currently, as Executive Director of Advisory, Retail, and Hospitality, Mr. Zia is responsible for developing strategic initiatives and implementing growth strategies for these business areas. Prior to Knight Frank, Mr. Zia was with Tata Housing for 8 years in various roles across marketing, sales, and project management. Mr. Zia is also an active participant in various industry forums and associations, and his expert views are always sought after. On behalf of our committee and our members, I welcome you, Mr. Zia, and thank you for agreeing to come onto our platform on such short notice. I now request you to take over and address our members. Thank you.
Thank you so much. Thank you so much, Karan. And like last year, should I start with Jai Jinendra to all the members of KCF? Of course, last time it was a live audience and the energies were obviously very, very different when we were interacting with each other with physical proximity. And in these days of social distancing, obviously, we are in the comfort of all our private rooms, etc. And obviously, that also brings me to this awkward situation where I still cannot personally connect with you all. But we have to live with it because these are the testing times, and I'm sure we will come out stronger. And next time when I'll be interacting with you, it will be definitely a physical interaction, I'm sure. Well, let me also, on this auspicious occasion of Janmashtami, let me wish all the members of KCF on this day of Janmashtami. And since the topic that we're going to talk about is something which brings lots of gloom the way we are right now. So this is obviously the reason why I wanted to start on an auspicious note. And that's where the greetings on Janmashtami would definitely come in handy for me to start with. Well, the way we spoke about before this presentation was, or this session was to roll, I have offered that I'll share my thoughts for about 15-20 minutes, or if you allow me, it will not stretch more than 20-25 minutes for sure, on what's the current state of affairs on this sector, on real estate sector. Post which I would love to interact personally with many of your members who may have specific questions about specific locations, specific asset classes, and cross-section of both. So if I have to start with where we are, is the first topic that I would love to pick up on this platform. I'll spend some time on what's going on right now and what are the possible trends that may emerge once we are on the other side of COVID. And that's exactly what that's exactly what is expected from me. That is the line of thought which has been passed to me by the organizers of this event. So if I have to start with what's going on, or where are we today? Well, let me also end, since we had about 3 years back, we had interacted with each other. So if I have to if I draw bridges between these two events and look at what is happening right now. that was a time when I was talking about gloom setting in, if you all recall. I was talking about the dark days for real estate ahead. And those are the days when many of the stakeholders in the industry were not very happy with us talking about it. And before we go forward, let me also very humbly accept that we are not the market makers. We only talk about what's happening. And as a result of it, many of us end up believing that because we are saying something, that thing shall happen. Well, it is not so. Please don't put me on that pedestal where whatever I say would come true. I would love to then talk a lot of different things which will make all our fortunes swing upwards, but then because I don't have that liberty. So please understand what I'm going to talk about is based on our analytics, based on our understanding and experience of this market. And this is not to really put a sector down. And there is obviously, very clearly, no conflict of interest here, due to which we'll be talking a few of these things which may not sound very good. But that's exactly what 3 years back we were talking about. And if I have to believe that you have called me back again on this platform, and as Karan was talking about when he was calling me to talk, perhaps that frank discussion, perhaps that frank expression of my thoughts, perhaps clicked with many of the members, and hence I'm called again. So if I have to, take that as a consolation for me to then continue my discourse, I would definitely feel better to then get into what I'm going to talk about. And that's it. Let me also then quickly put up a few things in order. When we're talking about the gloom, this gloom is not across the real estate. A few of the sectors, and I'm sure most of us would be aware, those who are investing in real estate would be aware of it, that real estate obviously comprises of various different asset classes within the master asset class of real estate. And then, of course, the sectors, the regionalities, the specifics of each properties are so different that it's not possible to give a generic one size fit all kind of a perspective to the whole industry. And hence we have to also put this in order that while the end of 2019, we were very, very bullish about at least one or two of the sectors. First of them was office sector. The office, the commercial sector in India was booming, to say the least. 2019 saw highest amount of office space transacted in the whole year. For the first time, we crossed 60 million square feet of office space transacted in one calendar year, which was last year, 2019. So it was actually going perfectly fine for office sector. On the other side, retail sector also, after a long time, was fairly settling down. We had at least one or two malls in each of these top 7-8 cities doing well, exceptionally well. Of course, not every mall could actually perform good. So that's exactly the reason I'm saying a couple of them, maybe one or two. It's not that a city like Mumbai MMR or Delhi NCR are the cities where you could develop 15, 16 malls and all of them would perform. That's not what it was. At least 2 or 3 malls in each of these cities were performing well. Whereas in every other city besides those top 6-7 cities, at least one mall would do well. Even if I'm then going down to tier 2 cities, and I'm sorry if tier 2 cities may not sound well as a tag, but then pretty much almost about 25-30 cities I can name, which I would want to believe fall in that category, where at least one mall in those cities was doing fabulously well. So overall, retail sector after a long time was coming to its fore, coming to really to be matured as an asset which you would love to invest in. And of course, when I'm talking about retail, let's not forget about the high streets, because we on this platform, I understand and I reckon that a lot of us will be high net worth individuals, and hence the asset classes as far as retail are concerned would then also get into shops and smaller units. Why even taking a step back, even in commercial spaces, it was obviously not all large floor plates, but also smaller offices, which many of investors who are sitting on this platform or in this event today would be investing in. And for them, it was a great asset class. Both retail as well as commercial have been great asset classes. Of course, the problem with these organized market of either commercial or retail, the problem there was that most of these spaces were huge, were large, and hence smaller investors were finding it very tough to find their way into these markets or these asset classes of retail and offices. Very few asset class, very few properties were available, which would be given for 2-3 crore ticket size. Smaller offices in say BKC or Lower Parel or a few of these locations in Mumbai or Delhi, Nehru Place, or a few locations in Gurgaon, and a few places in Connaught Place, etc. So these were a few exceptions, but largely most of the new office space that was coming in or retail space coming in was falling into that category of large office spaces or retail spaces, and for which small investors had very little scope to play in that market. That said, the last asset class which I would love to talk about before I move on to the current scenario is residential. And that's exactly what I now connect with the dots. The previous time when I spoke on this platform, I was very categoric that this is one asset class to keep away from. And I continue. In fact, if I have to really elaborate upon that, even in the last part of 2019 or early 2020, residential as an asset class was not to be touched, absolutely untouchable, purely because there was no sense in investing in asset class, first of all, which doesn't give you good rental return. At 2% or 2.5% per annum kind of a residential yield, it's an asset class which doesn't pay you well as far as recurring incomes are concerned. And since I'm talking about it, let me also compare it with the other asset classes, which is retail or office sectors. Well, there 8 to 9% is a commonly accepted rental yield per annum that you would expect. Of course, because this is a very niche market for ultra high net worth individuals or small investors who would want to buy smaller properties, very little inventory and a lot of people to buy those properties. Hence, the yield there would shrink. So there have been instances in BKC where properties were sold at an expected inventory yield of about 6 to 7% also. Ultra high net worth individuals who are buying these properties with an income return of about 6.5 to 7%. So it actually shrinks when the inventory is very little and the demand for it is too high. So compared to conclude on residential, comparably, it is actually giving you worst of the returns. And of course, the moment I talk about returns, then people are saying that, why do you forget the property price appreciation? Yes, which is true. Property price appreciation is highest in residential under normal circumstances, and it is not as high in the other two asset classes, which is retail and offices. However, even that price appreciation for last almost half a decade has been very, very bad. And on the other side, your inflation is also ticking. So even if I talk about 5 to 6% appreciation in prices, and if your inflation is going at 6.5%, 7% or 8%, net you're in a negative. So even if you club these two together for a residential property, you would obviously look at yield, the rental return plus the property price appreciation. Even if I put the two of them together and look at the scenario for residential property, even then it's an asset class which puts you hugely in a negative. So your returns on residential properties have been bad for last at least half a decade. And it continues, even as where we are, it continues to be so. People may ask that what has happened to all those large programs that we had gotten into, which is housing for all, many of those infrastructure initiatives that we had taken up in many of these large cities, etc. Why won't those initiatives give some additional appreciation to residential asset class? Well, it is not to be. Let us understand, if housing for all, let's just look at a hypothetical situation where we are getting into housing for all. Assume everybody under the sun has a house, then who would you create the next house for is a big question. So assuming if housing for all had to be successful, then obviously residential as an asset class is dead. You obviously don't need residential as an asset class to invest into, to look at your property, your money growing, to see your investment giving you better returns. Well, if housing for all has to succeed, obviously that whole case in point is dead. And then comes the question of infrastructure. Well, infrastructure is expected to give you a good return or a good value appreciation for the property. But then if the demand is still very, very insignificant, then the buyer would still not give you the value for the additional infrastructure that would have come in. Like, for example, if I have to talk about Mumbai, in Mumbai, we do see a lot of these metros nearing completion. We have seen in last couple of years, we have seen the Eastern Corridor opening up. As we talk about the western side, the coastal road is under construction, as well as the Bandra-Worli Sea Link is now, which is now to be extended from Worli to Warsaw. Sorry, from Bandra to Warsaw and Worli to Nariman Point. All those works are going on. So obviously there is a direct value add, direct benefit to all those localities. Imagine when this metro, underground metro, will be going all the way to Kaf Parade. Why shouldn't the property price in Kaf Parade or Nariman Point increase? Obviously, there is a very strong case for it to increase. But then it has already reached a certain level at which the price expectation, the buyer is not willing to pay the price which was existing for last couple of years. So that is where the problem is. If infrastructure improvement was expected to add value or to increase our property prices, it hasn't done so. And going forward also, now let's talk about, this is where we are. And the three asset classes I spoke about. Well, let me quickly even talk about one more asset class which not many people talk about yet, is warehousing. Warehousing, of course, it's a very, very niche property asset class, and those who are invested in it, those who know about it, have been reaping rich benefits. These are the old mom and pop kind of old structures which are typically given up for storing something. Warehousing is actually, it used to be a very, very neglected asset class. In last half a decade, with many global players coming in, and of course with GST going off, GST coming in, all those improvements in overall investment scenario coming in, warehousing has shot up as a preferred asset class. And in all this I'm talking about is pre-March 2020. So why am I talking about it is that slowly I'm preparing a scenario, or I'm slowly, gradually coming in at that day I call upon as the COVID day, somewhere 22nd of March, where all hell broke loose. Prior to that is the picture which I'm painting so far. This is exactly how real estate was. And of course, there came COVID. And COVID really disrupted everything. Whatever was going well actually came to a grinding halt. So the best asset class, offices, commercial office spaces, something which was actually darling of every investor, that asset class suddenly was not finding takers. And the problem was very evident. A few of these stalwarts in the industry started talking from rooftop that by the time in next couple of years, I will have 75% of my office, my colleagues or my teams working from their homes. So what came up is work from home. And then work from home then brought about a lot of these question marks for this asset class itself. So if this biggest office occupier, the company I'm talking about, which was proclaiming that by 2025, 75% of their people will be working from home, mind you, they have millions of office spaces occupied by this just one occupier. And when I say millions, my guess is that it would be at least 15 to 20 million, if not more, occupied by this single occupier. And please compare it with overall some 650 million square feet of office space that we have in India. There's the overall inventory as on date. So 650 million office square feet of office space, of which one taker is giving you, if at all it does, assuming that 75% of the office space occupied by this specific occupier has to fall vacant. At least 10 million square feet of office space will fall vacant. And that is only one occupier, mind you. So if it has to snowball, if everybody starts thinking about this whole new paradigm shift of working from home, then can you imagine if it has to be true, then what will happen to that 650 million square feet of office space that we have in store? Millions of office space could fall vacant, could become haunted mansions. And that since I'm talking about haunted houses, it reminds me of a very scary picture. When I came into about 15 years back, when I used to go towards New Bombay, the Belapur and all that Vashi Belapur belt, it was expected to be the replacement, or the CBD Belapur was supposed to replace the BKC and the Nariman Point, etc. We created huge office spaces over there. And there have been long period of time where nobody was occupying those large, huge edifices. Nobody was occupying those properties. And that is what I'm talking about. If at all, what these people backing on work from home concept, what they are painting, that picture that they are painting has to come to God only save where we are as far as office spaces are concerned. However, I'll come forward, going forward, I will talk about it further. But prior to that, let's talk about the other asset classes. And when I'm just trying to paint this whole picture, pre-March 2020, then on 22nd March 2020, where were we? On the onset of COVID, office space had the biggest jewel to face. But on the other side, let's not forget about the problem facing by retail industry. And that retail is not just malls, even high streets and the small shops as well. I'm sure many of us who are sitting on this platform today for this, attending this event today, would be holding a few shops here and there also. And I'm sure their occupier would have already been knocking their doors asking for waiver of rental for a couple of months because there is no business, or asking for correction or reduction in the rentals for next couple of months. These are things which are happening for retail. And while Unlock 3, we have entered Unlock 3, even now, retail industry is still in a very, very bad shape. At least the malls have started gradually opening up. But even this opening up, because of all your social distancing norms, etc., and a few of the key crowd pullers. One is the theaters and the other is the F&B. And of course, the third is the entertainment, which is the family entertainment centers, the bowling alleys, or the game arenas, etc., in these malls, which have been the major drivers behind people coming into those places time and again. They are yet not allowed to open. So here it is. The retail as a sector has taken the deepest bruise, has taken the deepest wound. And hence, and when I'm going forward, obviously the statements I'm making will come back, will reverberate, and I'll try to explain why am I saying whatever I'm saying again in a few minutes for each of these asset classes. But here it is. Retail is, and it continues to be in the worst space ever. About 7-8 years, 10 years back, retail was once again passing through a bad patch. But that bad patch was for some different reasons. Number one was the inventory created was huge. And this is unfortunately where we as developers don't really do our homework before entering into any of these developments. What happened then at that time when development of malls, a mall as a concept was looking so glamorous, looking so sexy that everybody wanted to make a mall of his own. Everybody made a mall. So once suddenly there was a situation where there were so many malls and the city could not afford more than 2 or 3 malls. So that is where the shift came in about 10 years back. We had huge number of malls, almost about 250, 300 malls were under development in India, and out of which at least 100 malls never saw the light of the day. So that is where it was. Retail had seen bad time earlier, but the bruise or the wounds given this time, the wounds inflicted this time are far, far deeper than what we have ever seen historically. And that is where a lot of people have been asking us about COVID. What do we see on the other side of COVID? And here it is. And for a few minutes, you will believe that I may have wasted your time, but this is exactly where our position is. My global head, the head of my organization sitting in London, was the first one to say these words: we don't know. So whenever somebody would come up to us and ask what is happening on the other side of COVID, how long does COVID last, what happens once COVID is over, etc., our submission was, I don't know. There have been people who started making some statistical instruments or tools and then started giving you some forecast or this or that. But here it is, none of those forecasts had enough substance or data backdrop, because for any statistical tool to succeed, you have to give a good science sizable number of data you have to feed in terms of your past experiences or whatever future variables could change, etc. You need to have a very dependable command on variables as well as past data. In absence of past data, and why do I say in absence? Well, the last time we saw a pandemic of this nature was in 1918. The whatever was it called as the Spanish flu, 1918. Or that is more than 100 years. We don't have a single, at least I haven't come across anybody who would be here, who would have seen that pandemic and now seeing this. So it is not possible for us to even pull out the data of that time. I was just, as a simple anecdote, I was going through some BBC reports of the year. India had the highest number of deaths occurred in India. That was immediately after World War II. And a lot of those things happened, and the huge the degrowth of GDP is also recorded somewhere in BBC, but none of those numbers are such which are absolute reliable data which can go into my statistical programs that I create, regressions, etc., and give you some forecast. So in absence of all that, at least we very humbly say we don't know. So if you're asking me how long this continue or what do you expect on the other side, when will it end, I don't know. But here it is. While we say so with all humility, we also have on the other side some expectations. And these expectations are coming out of our experiences, are coming out of trying to draw conclusions based on whatever data we have. Like, for example, one data set that I can always rely upon was about 2007, 8, and 8, 9, when the global financial crisis happened. And that time also, the office market shrunk hugely. Office market shrunk, the retail had a tough time, etc. Residential had a tough time, but residential bounced back in 2010. Within 2 years, residential market bounced back. And let us also not forget, that was a time when the economy was very, very different. If you look at the overall size of Indian economy, we were perhaps about 1.5 trillion or so. And today we are almost about 2.5 or 3 trillion thereabouts is what we are hovering. So here it is. We have grown exponentially in this period. A lot of things have changed. So none of these forecasting tools that I would love to rely upon will give me a convincing answer to tell you exactly what future holds for any one of us. So it is absolutely uncertain. So what lies on the other side of COVID? Very difficult to even gauge or estimate. But having said that, we have to still understand if we have to continue in the business, what shall we do? There it is. So what I have started with was what it was pre-COVID. Then I had a few minutes on what the COVID situation has brought upon us. And here, next couple of minutes, I'll share with you about our expectations of what future could be. To start with, the office market that we are talking about, which has seen such a bad time, or where we are right now facing such a tough time, rent corrections, vacations, people leaving office spaces, etc., all that happening on one side. But on the other side, the work from home that we have been that I would say it's a creature we are so afraid of as developers, of course, or the property owners. That is not something which is to be scared of. One reason to start with is work from home. When they're talking about, a lot of these people who spoke from rooftop themselves have actually occupied or transacted millions in last couple of months of COVID. On the other side, there are a lot of these big players like Googles and Facebooks, etc., who've been taking more and more space. A lot of other people who are waiting in the wings to get the right deal and actually about to sign up on millions of square feet as we go forward. And this is on-ground reality. Of course, my teams and various of our other friends and colleagues from the same industry are out there on the field, and we will convincingly tell you that it is not so bad for office space. Of course, there will be the scar, and the scar will take some time to heal. But in the interim, it is not something where we will have to really look at or expect, millions of square feet of haunted mansions. It is not going to be so. As I said, to start with the work from home as a concept itself, let me quickly spend a few minutes on this whole thing called work from home. It is not something new for this world. Well, it has happened It has happened when the global financial crisis came in. Americas went through a similar situation. European countries also went through a similar situation. And they already launched the work from home culture over there. So if you go to Bay Area, the technical, the IT hub of the whole world, that is where they have already started work from home about 10, 12 years back. And they have a certain size of their office, certain size of their overall number of workers working from home all the time. So it is not that this is something new or happening for the first time. Globally, it has been happening. But in India, we are seeing it, or at least we are talking about it because we are scared of it. We are afraid of it. It has been painted into such kind of a huge behemoth or something, a huge, what should I say, Rakshas, which will take away the office space along with it and the whole sector will die. Not really. Definitely not. A couple of things to start with. And we have done this empirical research. Very convincingly, we can tell you that if you have a choice of working from home vis-a-vis working from office, number one, the savings that many of these people are talking about actually is next to nothing. It's minuscule, and it is established. We have recently concluded a survey of some top 190, about 200 odd companies, and how their earnings are and their revenues, etc. And based on that, we have checked this out, that it will not even give them 0.1 to 0.5% of their revenues in terms of savings by working from home. After working from home, the saving that they can expect will be definitely much less than 1% of their revenues. So is it so much to sing and dance about? Is it really something which I will have to start standing and talking that soon half of my office staff will be working from home, etc.? Well, all those things are there, but the impact of that on office spaces will not be as it is painted to be. It is not going to be as bad as what many of us want to believe it could be. Number one. And number two, let's also, and since we're talking about it, let the pendulum swing the other way as well. I'm sure many of those audience would also find out, would also ask that now with social distancing and this and that coming, you would rather to occupy same 100 people in an office, you will require 150 or 200 square feet compared to earlier 100 square feet that you would have been taking. Well, it is once again not to be so. If we are expecting that this will come as a blessing in disguise, the social distancing will allow you to take huge office spaces. Mind you, you have to really analyze it a bit more. First of all, in an environment where there is a shrinkage of GDP expected and accepted by the financial experts of this country, thousands of lakhs of jobs will be lost. Don't you think it will have an impact on office, the requirement of office shrinking? With that shrinkage happening, how can we expect the demand to shoot up? Just because of social distancing. Point number one. Point number two simply is that today Russia is talking about a vaccine, and many of us will be happy. We are waiting. We're actually anxiously waiting for some convincing vaccine to come up in the market. Russia has already started talking about at least 3 vaccines are at the stage 3 of approval. So maybe in next month and a half or 2, the vaccine will be in the market. I am optimistic. I am on the side of hope. So I hope that in next 2 months, by October or so, we shall have vaccine available in the world. And if so, it will be yet another forgotten chapter. It will definitely be like, if I have to draw your attention towards H1N1, SARS, and a lot of these things that have come in earlier. Well, let me tell you, about 10 years back, a similar situation was painted in the Far East, Singapore, Hong Kong, and these locations where office spaces were actually expected to be falling vacant because of a similar situation. But the vaccine came along. And once again, you completely forgot. Today, how many of us are even worrying about H1N1? Has it been eradicated? Definitely not. But are we worried about it? Definitely not. So that is the case. That is exactly what is going to happen the day we have the vaccine for COVID available in the market. Once again, it will be a forgotten chapter. So then are we expecting an economy like India, which was already a 3 trillion economy and expected to grow to 5 trillion in another by the 75th anniversary of the independence, etc. So were we expecting that such a large economy An economy which is growing at the breakneck speed. If you ignore China, we are the fastest growing economy of the world. We have the largest human capital in the country to talk about. So with so many advantages behind us, are we believing that we shall be getting into a doomsday scenario in times to come post-COVID? Definitely not. So the only outlier that we are worried about is COVID. The only thing that has changed, if I have to once again draw your attention back towards 2017 and what it is today, the only thing that has changed is COVID. And once again, if COVID is outside of the picture, then we are back in business. We are back where we had left it from. We are back in the January and February of 2020, which was a fabulous office market, which was a great retail market, which was a booming warehousing market. Residential was yet to be wait and watch, but still it was not that bad. So if I have to look forward next couple of months, by the end of 2020, we shall be outside of this whole glut or this whole bad COVID scenario that we are in. And on the other side, enter 2021, we shall see business as usual. Economy shall be roaring. In fact, just about a couple of days back, I was looking at it. The expectations of the growth, somewhere by August of 2021, they were expecting the GDP growth once again to be positive, and perhaps one of those rare economies in the world where we are observing such kind of a shift to happen. So if you're talking about from a shrinkage in GDP to a booming GDP, obviously the swing is so huge, so large, that the impact of that has to be felt in the Q1 of 2021 itself. And that is evident. That is the reason why the strategists, all those strategists who are sitting in war rooms and looking at the COVID scenario, are talking about erasing 2020 from their business profiles. What does it mean? They're talking about take 2019 as the base case for the growth projections of your 2021. So what we're talking about is forgetting about 2020. It is simply happening because we have that conviction that the COVID will be over, that we will find the vaccine for COVID. So 2020, the way it has come, it will go back and take the COVID back with it. While it may sound very, very hopeful, but I have full conviction it has to happen because the kind of research happening in the pharma industry is giving us conviction that we are going to see next 2-3 months, we shall see the end of it, this whole thing. And at least those who are sitting in Mumbai, we have already seen the curve actually going towards negative. So we can vouch for it. Of course, we are still scared of a rebound kind of a scenario. God forbid we have to ever face this. But hopefully when we are reaching that phase, the vaccine will be in our hands and we would have forgotten this whole COVID scenario. So here it is. If I have to talk about what future holds for the real estate asset classes, well, office is business as usual. We shall, in 2021, we will have office spaces once again booming. Well, retail, there will be a problem. What has happened in the meanwhile, while retail, the actual mom and pop stores, as well as the physical retail was going through this tough time of COVID, the e-commerce took up. The flight of e-commerce was enviable. Because all of us were sitting at home and ordering stuff, whether it is grocery or anything else that we would need, including electronics and everything else. We were ordering all this. So these guys who were in that industry have made huge money. They've actually it came in as a huge, what should I say? It was a blessing in disguise for the e-commerce industry. So some chunk of the retail has already been taken away from the market in terms of e-commerce. So the stores, the shops, the mom and pop stores and the malls, etc., shall see some longer time to bounce back. Well, it is already being written. Many of the players are coming back with a bang, with a better offering, be it theaters, etc., or F&Bs. F&B shall take much longer to come back because the problem with F&B are profound. Even if we come back, how do we really ensure that we are following the social distancing, etc.? Will continue to haunt that industry. But that said, retail shall see the longest time to bounce back. Maybe another year at least. 2021, by end of 2021, we may say real estate finding its bottom and slowly, gradually coming up. warehousing was already doing well. As I said, because of this whole e-commerce taking off, the requirement of something called as center city warehousing, at least in India, it's a new concept, because you want to actually cater to the requirement of your clients within a few hours. So what today, a few of them talk about 1-day delivery or same-day delivery. Here we're talking about within an hour kind of a delivery, which obviously requires multiple of these center city warehousing to be created, from where you could cater to all the areas around to be catered to within an hour of your ordering. So all that happening, warehousing was in any case doing well. So ultimately, the last asset class I'll come to is residential. Well, residential shall still not to be touched upon. I would still not advise anybody to talk about residential, because we still have to find the bottom. The problem is very severe. The problem is also very severe because even before COVID, this sector residential part of it was going through a tough time. While the government initiative of giving some amount of putting up some distressed asset fund, etc., has also not taken off well. It is still slowly, gradually coming up. Real estate regulator has been a disappointment so far, in spite of operational for almost about 3 years or more now. So a lot of these initiatives that have happened, in spite of government doing its best to make this sector survive or to get back into normalcy, it still is far, far, far from normalcy, largely because of the consumption itself. The demand and supply gap is so wide. Of course, supply also will be shrinking in times to come. But let us not jump to conclusion that because supply is shrinking, then you will have everything, all your problems be sorted out. Not so. Even when the supply is shrinking, the demand has already shrunk to such an extent where this shrinking supply itself will also not really have much of an impact. So net, the problem for residential shall continue for much longer a period than the other asset classes, and which could be at least 2 years. So if this downturn for residential asset class has to continue for 2 more years, and your returns on this asset class and appreciation in the asset class continues to be negative in the next 2 years, then this is an asset class not to be touched. Let me just quickly, before I conclude, I always tell this, I'm sure I would have said so earlier as well. If your property prices are not doubling up, please mark my words, if the property prices are not doubling up in next 5 to 6 years, don't buy that property, because you have better asset classes to look at. I'm sure most of you all will have access to stock exchange, would be already playing with gold and many other asset classes. And let me tell you, these asset classes are paying you better than real estate if the property prices are not doubling up in 5 to 6 years. So if you are a smart investor, you can locate that gem where, first of all, you may get a huge discount. If the market price is 100 rupees, you may successfully negotiate and buy this for 65, 70 rupees. So your entry price will be that huge advantage you will have at the entry price. And then when it comes to exit position, you can actually wait and watch, and even if it is increasing at 5-6%, maybe after 3-4 years or 5 years, you may see about doubling up of the price if your entering position is very, very enviable. So my point simply is, if you are a vulture investor, please mark my words, where you can get a deal where somebody is actually in a distress and giving you a huge cut, about 35-40%, then buy it. Then it's not a bad deal. You shall see the property prices going up in next 2.5 years later, not in the interim. So those who are entering at market price, you should not, because the prices shall not double up in next 5 years. Purely because if next 2.5 years of the 5-year horizon is already is erased, then remaining 3 years is such a large appreciation. You will have to have annual appreciation. Like I would say about 12% or so annual price growth it has got to be. Only then will you have a doubling of the prices in 5 to 6 years. And if it is about 2 years gone, then your property prices in the following 3 years of a 5-year block period have to increase by at least 20 to 25% per annum, which is not possible. So here it is. Before I conclude, my point is, in terms of asset classes, future office spaces are good. If you're getting a a good pre-let opportunity where some good occupier is already sitting there, even if you are picking it up at 5.5 or 6%, you may take it purely because the rent appreciation shall also kick in, and you may also want to trade it later and sell it off later when the property prices start, office property prices start shooting up. Retail in the interim is not looking bad, but if you are sitting on a retail property, don't be in a hurry to sell it off. Keep it with you. Because in a year and a half, we shall see the business as usual. The consumption story of a large and a strong economy of like India cannot be doubted. You cannot doubt such a large consumption economy, consumption-driven economy. So if it is consumption story, obviously, and if you have a store or a shop somewhere, don't sell it. Definitely don't sell it for a distress. A year or so from now, the things will fall in place and you'll be happy that you have not sold that property at half the price. So in a nutshell, that is where it is. Residential prices not to be touched. If you want to buy something, buy warehousing space, buy office space. But still, if you are in retail, don't sell it. Wait for it, it will come back. That is a submission from me, and here it is. I'm open to question answers. I'm sure a few questions would have already come. So I'm passing it back to you, Karan.
Fantastic session, sir.
I'm sorry, I think I overshot. I thought I would take 25 minutes. I think I ended up taking much more than that. My apologies.
But sir, I think this felt like less than 25 minutes, given the kind of passion with which you spoke, and I believe the positive booster which you gave all of us. So I would like to take this opportunity first to propose a vote of thanks. And I would also like to inform the viewers that they can actually start posting their questions on the chat box, which we shall take them up one after the other. I guess very well put, BC and AC, that is before Corona, after Corona, and more so the long-term effects after Corona, which I think is a huge positive boost for all of us. We thank you for coming back to this platform, Mr. Gulam Zia, on such a short notice. I definitely believe that we need your wisdom every few years, so please expect our call, and hope, you'll come back again and again to our platform to, get this knowledge spread across to our viewers and our members. Now, before I start the questions sessions, there is another announcement from Kutch Corporate Forum. We have always believed in staying ahead of the curve, which is why we have felt that it is essential that businesses deep dive into what they're doing, introspect, and get better and better. Some weeks back, we had kept a session by Mr. Manan Vasa, who is a productivity coach, and it had received an overwhelming response. Vivek, can you just share the slide, please? So in keeping with that, we in fact received a whole lot of queries as to why not deep dive into this. In fact, we have received a record number of almost 17,000 views on our YouTube, which was the Manan Vasa series of lectures. And for that, we thought that why not look at deep diving into this, which is where we have now spoken to Manan, and he is ready to do an intensive course with a smaller audience size. So this would be a 40-day course, which would be about 20 hours, and which will have 6 live workshops and follow-up sessions. Here, thanks to the efforts of our past presidents, Ashok Shah and Mukesh Dedia, Manan has set up a special price for Kutch Corporate Forum. So it will be 15,000 instead of the 40,000 which he's charging. And more so, if we sign up earlier, there will be another 10% discount. So there are 2 batches which we have. One is, of course, the weekend batch, and there is a weekday batch. So the communication will be sent to you separately. Here, it's like a 40-day long intensive workshop, 6 workshops with Manan Vasa himself, weekly follow-ups with his team. There is also free productivity app for 6 months, which also we have negotiated. Earlier, he was supposed to charge extra for that, but now this comes in complimentary. And there is free access to his business network group for 6 months, which is also a big plus point. There will be a productivity report card and a certificate of participation. So I would urge all those members who are interested to sign up at the earliest. And like Manan himself had said, कि पकड़ के लोगों के पास से काम करवा लेंगे. So 30 seats only, and hope this gives the maximum amount of benefit to our members. With this, we will start our Q&A session, and I would request Ketan Gala, our committee member, to take over from here. Thank you.
So good evening, everyone, and thank you, Mr. Gulam, to give us such a lovely talk on real estate and being realist. I think it's very, very important to be realist and not to have unrealistic dreams. And I think you've painted a real good picture. The questions, quite a few have come in. The first question is, what are your views on REIT as an investment class, considering the underlying office properties? Any pitfalls which one should consider?
Well, REITs, of course, something which I didn't even talk about. And surprisingly, I think I completely missed mentioning a REIT. But real estate investment trust, especially for offices, are still at their very, very nascent stage. It's only the second REIT which is just about getting listed as we speak. This is the second one, the Raheja REIT, Mindspace REIT that is coming along. Prior to that, there was only one, which was the Embassy Blackstone REIT, which has come in the market. This got listed. The performance has been decent, except for COVID. If I have to once again forget about COVID, then it has given a decent performance on the stock exchange. So encouraged by that, the second launch, when Mindspace launched, these days were very, very, I'm sure the promoters themselves were very skeptical when they were going into it. But then the response was fabulous. It was heartwarming. It was so good to know. It was so good to note that the investors have faith in office market. And if I take you back to the last part of my submission, the future for office market is fabulous, in spite of whatever is happening right now due to COVID. But the overall larger picture, the mega picture that you're looking at, an economy which is growing from $3 trillion to 5, and from 5 to 10 in next following whatever 7, 8, 10 years, etc. This is a booming economy. And that booming economy requires office spaces to cater to the need of that booming economy. So this is one asset class, the demand of which is unforeseeable. It is huge. So I'm sure the investors of that REIT, the second REIT that we're talking about, also realize that. And even in such tough times, they got fabulous response from the market. So the REIT, the question that you asked me is, what is my belief or faith, or what is my understanding of REIT? I'm very convinced that this is one asset class which shall do well. And it's a good asset class to keep in your portfolio. Well, globally, real estate REITs are kept in the portfolio only to reduce the beta, to reduce the huge variances, etc. Because this is one asset class which doesn't give you superlative returns. It is not something which will be like, for example, the Reliance or Infosys, etc. kind of shares. These are not such kind of shares which will give you multiples, but they will actually reduce the variance in your portfolio, and good to have. This is one asset class which will never give you negative returns. It's one asset class, even if it is coming below, because of course there are a few situations like these, the calamities like COVID, etc., which may have some momentary impact, but net, it's going to be very good. And let's not forget, we are just entering into REIT era. It's only barely the second REIT we are looking at. There are tens of other REITs which are expected to come in next year and a half. There are tens of those developers and property portfolio owners, etc., who are keen to get into the market. And mind you, this is the first phase, as I said. Second phase will be that of transactions or the trading of office properties from one REIT to the other. This is what happens globally. And we are just about entering into that market. And of course, it's only office. Gradually, we'll get into retail. When times is ripe, when asset as an asset class, residential is looking good, we may get into residential REIT as well. And of course, infrastructure is not the topic of today. I would love to talk about it on a separate platform. It's once again, this is one country to grow from 1.5 to 2 trillion to 5 to 10. We require a huge amount of infrastructure boost. So infrastructure REITs, InvITs have also come in the market. So there are a lot of these investment opportunities available. We must capitalize upon them. So in my view, it's a great opportunity. And you're asking about what should we watch out for? Well, number one, as I spoke about, don't expect huge returns. Your prices will not double up every 2 years or so. But this is something which you can rely upon. It will never fail you. It is something to have in your portfolio to give you a decent return. Globally, REITs are looked upon from the major investors, and the REITs are the provident fund and pension funds of the world. Why? Because they're fine with 6 to 7% return. And once, mind you, those guys have not come in India yet. And once they start coming in and their expectations of returns are so low that if you have bought at that market price, you have another huge leverage of some 50, 60 basic bips or 100 bips to pull out of. So there's a huge upside still waiting for you. So as I said, it's an entry point for the REITs. From here onwards, you will see a lot of these REITs market opening up, and hence your returns shall continue to grow. So please don't be so skeptical. This is great asset class. Invest in REITs. Next question, please.
Thank you. So RERA was introduced in September 2017. How do you think that has played until now?
I think I had a brief mention of this in my submission, that it has disappointed. It has disappointed many because, obviously I would still want to give benefit of doubt to the policymakers. I'm sure it was expected that it'll take some time to settle down. Maybe as consumers, we were very, very anxious. We wanted it to start operating from day zero, which is obviously not to be. And the kind of federal structure we have in this country, whatever central government has conceived, by the time the state governments are properly implementing it, there'll be a lot of wastage of time in between. And yeah, I still want to believe we are passing through that patch. And of course, there are a lot of these lacunae, a lot of these gaps that are coming up, which we are realizing. I'm sure policymakers are looking into it, and they will continue to work upon it and make a completely foolproof regulator. But if you talk about history, last 3 years or so, it has not been too good. So going forward, of course, this is it will improve. My view is that I am, as I said earlier, I am a perpetual optimist. I'm sure we will together work on the systems and improve them. And of course, RERA actually came in when the real estate market was already in dumps and going down further. So what was supposed to come in as a huge boost to the market, or supposed to be the medicine for the ills of real estate, actually itself inflicted more wounds on the real estate industry. So once we are settling down, once the real estate industry, housing especially, is coming back to normal, at that time RERA will be a huge benefit to look upon. Right now, nothing much to sing and dance about.
A question on Mumbai suburbs. What do you feel about investing in Mumbai suburbs?
Well, I would actually once again draw your attention back to what I said. Next 2 years, don't buy any residential property if you are an investor. If you are an end user, no time is a bad time. You can buy today. In fact, as an end user, you should be happy to buy today, because the deep discounts are already there on the platter. So as an end user, you can buy, irrespective where it is. Your specific question is about western suburbs or such areas. Don't worry, if you're an end user, you can buy today. But if you're an investor, irrespective whether you are in western suburbs or central or in Navi Mumbai or Vasai Virar or Dombivli or Panvel or wherever, not a good time to buy. Definitely not a good time to buy. And I gave you the logic why. In next 2 years, the prices are not appreciating. And as an investor, your annual return annual return at least on residential property should be anywhere close to 12% plus. Which means even if you're getting 2.5% of rental return, your property price appreciation should be at least 8 to 10%, which is not to be, which is definitely not to be. And if you have lost at least 2 years with negative growth in property price appreciation, then as I said earlier, the later 3 years will be a huge drain, and you can't expect the property prices in the following 3 years at 20-30% per annum kind of a growth rate of growth. And hence, I would say don't buy, even if it is western suburbs. However, once again, as I said earlier, if you're getting seriously deep discounts, somebody who's the business is dying completely and you can buy at 35-40% discounts, buy anywhere, whether it is western suburb or anything else. There is a location doesn't matter much. Of course, location matters, but the location will matter wherever there are infrastructure improvements coming along. So please, as a good investor, don't just look at the property price. And I always maintain, especially, don't look at a residential property because of its glamour. You know, historically, at least in Mumbai, the best returns have come on the slums. If you would have bought a hutment somewhere in Dharavi, the return that you would have gotten over there would be far better than buying an apartment in NCPA. So I maintain that if you're an investor, please don't get swayed by the glamour of the property. Only if you are yourself going to be staying in it, look at the glamour side of it. Otherwise, look at it purely as a commercial play. I'm sure that's exactly what you would be doing in other asset classes. So shall be for residential real estate as well. Don't go by the glamour of it. And I'm sure many of them would be talking about western sides of suburbs because it was glamorous. You have Bandra, Lokhandwala, Andheri, etc., Juhu, and so on. Please don't get swayed by all that. It's only, at least as an investor, it's not giving you a good returns.
And for those who've already invested post-COVID, what do you think the scenario will be in terms of rent? Do you see a drastic drop in rent, or how do you look at that?
Ketan bhai, are we talking residential or other asset classes?
Commercial.
Commercial. Well, as I said, commercial, it's my favorite asset class. It could be passing through a bad patch today, but expect the returns, the rentals to get back to normalcy. In fact, it's very interesting. People are talking about rent discounts. And there have been pictures painted that the rental values of commercials are going down by 10%, etc. Don't worry about that 10%. It is nothing. You know, that 10% when you're talking about today's rent. Let me try to paint a picture. Assuming you have a property which is giving you 100 rupees rental today, and the occupier, the occupant comes to you and says, "मैं अभी 90 देता हूँ." अरे कोई बात नहीं यार, 90 लेने दो. Don't forget about that. Assuming this 100 rupees has happened in last year and a half. A year back, it was 90. The property price appreciation in office properties has been 5 to 10% for last 4-5 years. And hence, there are a lot of these occupiers who are sitting on these properties for last 3 years, 5 years, and their rentals or their terms are coming to an end. So an occupant who has been paying you 70 rupees for last 3 years, today you will be expecting 100 from him because 100 is the market price, and he's saying नहीं 100 नहीं मैं 90 देता हूँ. अरे कोई बात नहीं यार, आपका फिर भी 70 दे रहा था, 70 से 90 देगा टुडे आज वो. So net, the property, once again, when talking about rental, please understand the rental of today should not be the benchmark. Look at the historic background. So most of these occupiers who bought, okay, let's look at the 60 million. If you remember, I spoke about 60 million square foot of office space transacted in last year. So they are the only guys who paid today's rent. The guys, the 45 million the square foot of occupier who took last year have paid 15% or 10% lesser. And similarly, it goes on and on in history. So those who have been there for last 3 years are, as it is going to pay you much higher rent today. So don't worry about that 10% discount that you may give today. Look at the next year. Once again, you will be back to normalcy when that 10% will also come back to you. So this is one asset class. I would only say hold on. Nothing has gone bad for this asset class. In times to come, you shall see fabulous return out of office properties.
And what about those who redevelop their old buildings? This is the good time. Or where do you see that going?
Redevelopment, of course, I would segregate redevelopment in 2 categories, slum and old buildings. Now, as far as the slum is concerned, Yeah, the old buildings, and this is something which you'll have to give me a few minutes to explain this whole concept of redevelopment. You know, what is selling in today's market are the properties where a small building, which and now I'll come to the western suburbs. I also stay here, so I'll be able to explain it much better. Whether it is Juhu, Ville Parle, Bandra, or up to Andheri, Lokhandwala. Lot of these buildings, when you're getting into redevelopment, you're taking up 2 or 3 old buildings and putting up a new building there, in which you may have 18-20 story structure, of which at least 50% would be resettlement of the guys who are sitting there, who are there, would be taking it up themselves. The remaining inventory which is with you will not be huge. Most of these projects which I look at, the whole of Juhu and Ville Parle belt, etc., these are properties where a developer may not have to sell more than 15-20 apartments. And these 15-20 apartments, a part of them would still be bought by the existing builder, existing families living in the old building for their own expansion of the families, etc. So your marketing task is not that difficult. You know, real estate developers, which are the real estate developers who are in a soup or who are in a big problem, are the ones who have dreamt big. You know, when you're talking about selling 5,000 apartments every year, you are in a soup. The best of the builders in a project are unable to sell more than 25-30 apartments per month. So the velocity of sales is the key. Please understand, if velocity of sales is not favoring you, you are in a soup. So looking at the redevelopment story, Ketan bhai, that you're talking about, if you have a small property that you have picked up in any of these, say, Malad, Kandivali, Borivali, where your inventory to sell is not more than 25-30 apartments, don't worry, it is not a bad proposition. Your redevelopment phase itself will take you at least 3 years. और उन 3 सालों में आपको वो मुश्किल से 30 अपार्टमेंट बेचने, महीने में एक नहीं बेचोगे क्या यार? एक तो बिकेगा महीने में. So don't worry, as a redevelopment focus, if you're taking such buildings which have 25-30 apartments to be sold in next 3 years, please go ahead and take it. The demand is going to be here. This is a city. This is the maximum city we are talking about. The demand shall continue. Don't worry about this. The problem is only when somebody is asking you to participate in a large development. A large development where you have to sell at least 200 apartments every month. It is scary. Nobody for next 2 years will be able to sell 200 apartments in a month. Please believe me. But if you have 25-30 apartments to be sold, please, you are in a very sweet spot. Please continue your work. My best wishes, and I'm sure the business is on your side.
What do you think about the tier 2 and the tier 3 cities? Quite a few people are moving. And what do you see the real estate market in those areas?
Sorry, you talked about people moving into tier 2, tier 3 cities as developers, right? Or as occupiers?
Yes. As occupiers is the question.
Don't go by that.
Happening in...
No,
okay.
No. Please don't get swayed by such things. You know, because once again, these are concepts planted in our heads from March of 2020. Was anybody talking about it in February of 2020? I'm sure nobody was talking about it. The migration from the established established cities to tier 2 cities is only momentary. People will come back. Just tell me, sir, I'm sure all of us are aware of our cities. If we're talking about smaller cities that we have in focus, do you believe that suddenly the job markets of those cities have multiplied? If the job markets of those cities haven't multiplied, then those who are migrating there, what will they eat there? Won't they have to come back to the city which they are living today? And that's exactly the point. So don't go by this whole concept of migration. This migration was momentary. It was due to COVID. And once the vaccine is in place, COVID gone and forgotten, this migration shall also reverse. So please don't bet on the migration happening, and hence you should go back and buy something and develop something in Rajkot, Ahmedabad. Please don't do that. There is no story that will support your concept.
In this volatile market, what about real estate financiers? Their funding sources, viability.
What kind of financiers are we talking about? Are these retail small investors who are putting their money in projects, etc.? Is what the focus
Question
is?
doesn't have that, but I'm assuming they're talking about who are putting up for building the commercial and the residential spaces.
Okay, let me just ponder over this question a bit. I am still not completely clear. If you are buying a property, you are a direct investor. If you are a financer, obviously you are putting in money with someone else who's buying that property. So if you are a financer of that sort, when you're putting up capital on, say, Ketan Bhai has to go and buy some big office building, rent yielding, etc., then you have to also be very clear with Ketan Bhai which property is he buying. Is that property that he is buying is good enough to support whatever his commitments on return on the capital that you're putting with Ketan Bhai. So that is a concept you have to get into. So I believe that's what a financer is, right, Ketan Bhai? And otherwise you're an
Yes.
investor, right?
Yeah, that's what a financer is, right?
Yeah, so in that case, I need to get, I need to roll up my sleeves and dirty my hands. I need to, if, for example, I'm sorry, Ketan Bhai, not for any other reason, I'm only making a case that if Ketan Bhai today is, Gulam has to park money or funds with Ketan Bhai, Gulam has to understand what kind of business Ketan Bhai is doing. Obviously on one side there is faith that Ketan Bhai can never go wrong. His estimates are good. He has been a very established developer. He's doing a great job. That's one thing. But that said, you still need to understand where is he investing. If assuming he's once again making up a mall somewhere in Rajkot, then definitely don't put money even if he's Ketan Bhai. So please understand, go deeper into where that money will. Ketan Bhai, it's not on you. I'm saying you need to understand where are you parking your money first.
Yeah. What is your progresses on NBFCs primarily engaged in real estate financing and developer financing with the risk in today's market? Will the real estate financing industry suffer big time?
Big time. I don't know how many times do you want me to repeat that word big. Already NBFC has been in a big trouble. And of course, even if the one-time restructuring is allowed, which is what just now a couple of days back, a small window is opened up, one-time restructuring without impacting the health of your, without declaring it as a NPA. So that window is also very narrow, and it does not include or it does not expand or give cover to all NBFCs. So NBFCs continue to be in bad shape. And of course, let's also not forget that many of these NBFCs have indulged in malpractices and have done a lot of reckless investment. Even if I don't call it malpractice, them going and investing in properties where they didn't have enough faith in, or they didn't really do their homework and invested in or park their monies in such properties or in such projects or in such developers. So they are obviously accountable for it. And those NBFCs shall suffer. And honestly, I can't think of any NBFC which is not in a soup. So in a nutshell, if I have to summarize it, NBFCs are not to be touched at all.
Okay. What do you predict for trends for warehousing? Because you did touch upon that, but right now, because of the slowdown, do you see the rents moving southwards?
Well, first of all, rents is not a parameter. Please don't be fooled by the rent that you're collecting today, because that rent is a dynamic scenario. It is there today, will change tomorrow. So I'm sure all those wise investors who are buying pre-let properties, etc., where rental returns are coming in, don't look at the rent of today. It is the future rent expectation also that come into play. So the rent that are happening today or occurring today are not to be a barometer or a benchmark of the performance of the asset class. So the rents would have shrunk in a few properties in warehousing, highly likely, but then on the other side, there are many of these warehousing properties where the rents have actually shot up, especially the center city warehousing. Like in the heart of city, if you're putting up some warehousing in Bandra or some such place, suddenly you will have the Amazons of this world chasing you to get the share of the pie. So the whatever little correction in rental coming up in warehousing, once again, is not to be something that will deter you from investing in this asset class. the future for warehousing is bright.
Okay. Corporates in real estate may be better off with lower interest borrowing costs, whereas a small or a medium investor borrowing cost is above 12%, which is difficult to sustain in this kind of disruptive market. What are your views?
I'm sorry, I would want to understand that question well. So are we saying that is that question about corporate developers for whom the cost of borrowing is lesser and hence they are better off? Is that the question, Ketan bhai?
Well, they are better off. I'll just read the question again. Corporate
please.
in real estate may be better off because of the lower interest borrowing rates, whereas a small and a medium investor borrowing cost is over 12%, which in this kind of markets is difficult in disruptive markets. So basically, it's for the small and the medium investor, the cost of borrowing.
Yes, that's true. That's true. And obviously, it's a very I would say it's a very open-ended question because cost of borrowing is different for different people. I'm sure for individuals and retail investors, it will be slightly higher than the corporates. The corporates may be able to pick up money at a better rate. 100, 200 bips would be minimum arbitrage. However, that said, please don't believe that they are finding it very easy to pick up money from market. Even corporates are finding it very tough. The lending itself has shrunk in last couple of years or so. Prior to COVID also, lending to residential real estate was almost coming to a grinding halt. First, it was the government directive where the PSU, the public sector banks, were not allowed to to give money to real estate. And then the NBFC crisis came along. So net, the things were very bad for real estate, even if you're a corporate player. So it is not because you're a Tata or Godrej or Mahindras, the funds were rolling out red carpets and lending you money left, right, and center. It was not happening so. So you know what, Ketan bhai, it's something very different kind of a thought that have been coming up to our mind today. If nothing else, COVID has come in as a great equalizer. What do you mean by an equalizer? You know, the job losses were perceived that the job losses would be only in the lower end of the market. Not so. The job losses happened at the highest level of the corporates as well. Not just that, you know, the fear of, you know, the disease itself was also for the lower and lowest people of the bottom of pyramid as well as higher. So COVID has brought about a lot of equality in the world. And that equality has come in the business as well. So since this question is about differentiation between the corporate and the non-corporate, let me remind you that the difference is almost as good as gone. So this scenario is a great equalizer. So don't believe that corporates are at an advantage. Not really. You may get a better deal if you have a great track record. You may get a sweeter deal than even a corporate.
Give some indication on realistic prices in different parts of Mumbai for residential properties. Listed price of developers are still looking artificially high.
Which is correct. And you can't blame them for it. You know, there are, a developer has to go through lots of pull and push factors. You know, a developer would have picked up money from, say, NBFC or from banks, etc. And any price correction will only, you know, reduce the security he would have given to the bank. You know, I'm sure most of us understand that when I would have taken capital from anybody, a bank or an NBFC, I would have put up a part of my property or whole of it, the developed property, as a security. And if the valuation of that has to come down, then there's a huge impact. I may have to put up my house also as a security, my other assets also as a security against this just one building. So which is why most of the developers don't bring the prices down. At least the listed prices are never brought down. You may still sit across and do a great deal. So the price for today will be price for today. You may sit across and get the best bargain today. It may not last tomorrow. Please understand this. There are lots of pulls and push. In fact, Ketan bhai is a developer. He will explain it to you that we would actually, the margin of a developer is as good as gone. So today a developer is selling only to cut the losses. So don't you expect that you will get a great bargain and you should be laughing and smiling coming out of the developer's office. You should feel sad for this poor chap who's actually given you deep discount by cutting his losses. All you know, he may be putting his own family in trouble somewhere else. So it is not a game. I'm sure it's a business. Ultimately, it's a commercial decision. He's selling you, giving you a deep discount, but he's giving a discount not because he has a huge margin. He's giving a deep discount only because he's distressed. But the discounts do exist. So don't go by these listed prices. These listed prices are obviously only there for cosmetic purposes. If you want to buy, sit across, strike a great deal and move out. And at least feel sad for the developer for giving you a huge discount.
Tier 3 markets like Gandhidham, Bhuj, are those good markets to invest?
Well, these markets are fairly stable markets. These are not markets which sway like Mumbai. Mumbai sees, property prices doubling up in a couple of years, etc., and so on. And all these, in fact, you just leave Mumbai, Delhi to a certain extent, and some portion of Bangalore as crazily moving markets. The rest of the markets are very, very stable and matured markets. Why do I call them matured? Is because, your price in these locations, if you're talking about residential property, would still be in 2,000 price range, that about 2,000 to 2,500 rupees a square feet kind of a product that you will sell in these markets. And that price will not move much. So if you have, obviously, when you're getting into it, making a proper business plan, developing something and selling something, well, that property will fetch you whatever your sweat equity calls for. You will get it. But you are obviously not expecting that 2,000 rupee product to become 5,000 in Gandhidham for any reason. It doesn't happen. It hasn't happened. It will not happen. So those buildings, those businesses are matured. And once again, as an investor, if you're looking upon this as an investment decision, please don't buy, because those properties are obviously, as I said, are not going to double up. A Gandhidham product which you buy at 2,000 rupees, in next 5 years, are you sure it will become 4,000 or 5? If so, then go ahead and buy. At least in my view, it will never happen. I'm sure historically also none of these places have seen property prices doubling up in every 5 years. It has happened only in the top 3 cities, which is Mumbai, Delhi, and to a certain extent Bengaluru. None of the other markets have seen. Of course, I recall somewhere in 2006 or 2007, when Jaipur had seen a crazy jump. Time 2009-10, even Chandigarh saw some crazy jumps. But those are few exceptions. And then immediately later on, Jaipur also stabilized. Few locations in Jaipur were jumped up from 1,500 to 3,000, 3,500. But that 3,500 hasn't moved an inch in last 10 years. So there are some disruptions in these markets. And of course, you need to be a punter. It's not about an investor. It's not about an analyst. You have to be a punter to play in those markets, because you would have seen something which nobody else could have ever imagined. And if you are there in the right time, you may reap the rich benefits. Otherwise, if you are a calculating investor, you really go deep down and understand everything, you will not find any juice in these markets.
What do you think about investment in farmlands?
Okay, so we are getting into a new asset class called land. Please understand, land is not comparable to any of the built asset classes. What is a built asset class? Residential, office, warehousing, etc. Those are built asset classes. Lands are different altogether. Now, land is something, wherever you are, it doesn't matter which part of the country you are in. Land can give you 10x returns. It's the only asset class which can give you returns which nobody would ever imagine. But then it doesn't come in easy, and it is dirty. You must have seen what has happened in Gurgaon. You must have seen in multiple locations. You must have seen this in Sanand. You must have seen this in Dholera. A lot of these places where, huge government projects are coming up, the land valuations shoot up. And these valuations go up 10 times, definitely. Even in Mumbai, we have seen few of these land parcels, shooting up in property prices. And since you're talking about farmlands, I would love to buy a farmland on the outskirts of Mumbai, where I would know in future the city growth will happen in that direction. So, and this is what keeps happening. Every agglomeration, every large city keeps on expanding, taking a couple of villages every 10 years into its boundary limits. So when those boundaries of any cities are expanding and your property suddenly comes inside the limits of the city, obviously the property prices shoot up. So even recently, as recent as a year back, we have come across cases, say in Panvel, there have been instances of property prices shooting up from 30-40 lakh an acre to 4-5 crore an acre, 10 times within a gap of 5 years. So land is a subject which can get you unfathomable, unimaginable returns, but those are equally high risk, because once you get into land, you have to manage mafia, you have to manage politics, you have to manage right from tiller to the small farmer who will be farming on that land, etc., etc. You could be the owner, but he will have the benefits and so on and so on and so forth. So there are multiple problems, but the returns are huge. So even in recently, I recall about 2 years back, a large property was sold in Vasai. It was owned by Sahara earlier, and it was Sahara's about 6 years back. The Sahara as a company had bought this property for 100 odd crores, and within 6.5 years, they sold it for 1,100 crores. So 6 years, more than 10x is the price jump. So you can get that kind of a price appreciation in land, but please understand, it requires huge amount of I don't want to use those words, but then you have to be a different person. Chalta purza. They expect, and if you're not, then even if that property price is shot up, like you may own that property and the price of that property may shoot up from X to 10X, you may not get all that 10X. You may still get 3, 4X or 5X because the other people will draw those benefits. It has happened in many of the cities. Whenever the master plans, etc., change, suddenly you realize that your FSIs have shot up. Earlier it was 1, now it has become 2 or 3 or whatever. So your value, FSI is nothing else but the value of the land. So we have historically seen huge jumps on the land value, whether it is farmland or otherwise. There is a huge appreciation of land, but you have to be a person of a different nature altogether to manage the land investment. But it gives you the best investment.
We move on to the next question. What are the future cities to invest in commercial as per your study? In commercial properties, which future cities you would recommend to go?
Unfortunately, in our country still, we are not creating new cities. We are still focusing on the existing agglomerations only. When I talk about agglomerations, I'm talking about Mumbai is an agglomeration. Mumbai metropolitan region is an agglomeration, which includes Panvel, Vasai, etc., etc. So there are a lot of those fringe cities which have now come into one as Mumbai. So Mumbai, Delhi is also an agglomeration, NCR, MMR, Pune metropolitan region, Bangalore metropolitan regions. These are the locations where the action shall continue. If you are expecting me to tell you that Nagpur or Jamnagar or Ahmedabad, etc., will suddenly find the new flavor of the market, not really. Look, even Ahmedabad is one of the top 8 cities of the office market, but still it is taking fairly long time to come out of the shadows. Even today, the office absorption of an Ahmedabad doesn't even touch 1 million in a year. Whereas say Hyderabad does 5 million, 8 million, or even I think last year Hyderabad was doing almost 10 million. Bombay did 10 million. Bangalore does 18 million. So these are cities which will continue to be the flavor. The other cities, if you're expecting, say, a Nagpur or a Jaipur or a Chandigarh or a Mysore, etc., to suddenly become a hot property for commercial asset, not really. Because commercial assets are driven by the manpower. And the kind of manpower continues, the large city continue to enjoy the kind of resources that they have. The MNCs or the occupiers or the corporates, etc., will continue to seek more office spaces in these existing cities alone. So even if you're talking about a gift city in Ahmedabad, that gift city we are planning for last 7-8 years, 10 years, It hasn't seen that kind of a growth trajectory that a same building, even if you would do somewhere in the outskirts of Mumbai, somewhere in New Bombay, in the same 10 years, it would have been thriving today. But Gift City is still taking longer time than anticipated. So it is not as if a new city will emerge and you will have to focus on those cities. Of course, there are new cities people are talking about, whether it is Dholera or Amravati, the new capital city of Andhra Pradesh, etc. But look at that. Look at it this way. Politics has such a huge impact on it. When Amaravati as a new city was under development, the moment a chief minister changed, another chief minister came in, that Amaravati was now put to hold. So another 5 years gone from the growth trajectory of that city. So creation of a new city is a big problem in our country. We will still not see new cities coming up. Also look at it this way, with infrastructure improving, with huge road networks, with wider expressways, etc. coming up, with bullet trains, with metros and this and that, the action shall continue to be in these top cities alone. It is not going to move to any other city. So to answer your question, if you're asking me to give you prophecies about new cities emerging on Indian horizon, not really. Next 10 years, nothing.
We'll go, the time is running. The last question is, what about TDR market? Will the prices bounce back?
TDR, of course, now TDR is, I think the answer is about Mumbai, but TDR is today available in Pune and many other cities as well. And, TDR is directly, okay, TDR is a raw material. TDR is like land. It is nothing else but floating land. And that is a raw material which goes into construction. Now, if that TDR is going into construction of office property, obviously you will have large value. But if it is going into residential, it is one asset class which is passing through a bad time. So as long as residential as an asset class is passing through a bad time, and let's not forget that 80% of your market is residential. Overall real estate, 80% is residential. So 80% of your market is impacted, is affected. So TDR shall continue to be affected. So unless real estate market again takes off, the market prices of TDR shall not see any upward swing.
Great. I think this has been a great session, sir. And we are very, very happy to have you. We have we've taken a lot of your time today. Thank you very, very much.
You know, the beauty of this slot is that the whole night is yours. If I would be sitting in the office, I would say I have the next meeting to talk about. And even if I say that, you'll laugh at me. Okay, what next meeting? It is 10 o'clock in the night. That can't be any other meeting now.
True. So thank you very much for enlightening us with your views, and our viewers, I'm sure, have understood and gained some knowledge through whatever you've discussed today. Thank you very, very much.
My pleasure. Thank you.
Thank you.